Okay, I want to start with something that sounds almost, well, too good to be true in finance. Imagine a big company, maybe owning huge energy pipelines, something vital, and it trades right there on the New York Stock Exchange, just like, a massive tech company. But here's the kicker. This profitable, publicly traded thing, it often pays basically zero federal corporate income tax legally. And its investors. They get cash payments that are mostly tax deferred. It really does sound like the best of both worlds stock market access, but with this amazing tax shield. How on earth is that possible?
Yeah, it does sound a bit like financial wizardry, doesn't it? But it really comes down to the structure. We're talking about publicly traded partnerships or PTPs, and they are pretty much that hybrid you just described. They're engineered to give you the liquidity, the ease of trading like a stock, but combined with the tax treatment of a partnership.
Okay, PTPs. Before we really get into the nuts and bolts of how that works, and importantly, what the catches are, welcome everyone. This is everything you need to know about finance, and today, yeah, it's all about PTPs. And just a quick reminder here, this is us digging into the research, the mechanics. It's definitely not financial advice. We're just trying to explain how these things operate. And hey, if you find this kind of deep dive interesting where we try to break down complex stuff pretty quickly, do hit that like and subscribe button to keep up with us. So our goal today, understand the rules that let PTPs exist, figure out why they have these tax advantages, and also get real about the, let's say, administrative side you sign up for as an investor.
Right. So the absolute first thing to grasp is the core difference. You buy Apple stock, you own a piece of a corporation.
Yeah.
The corporation pays corporate tax. You buy into a PTP, you're buying what are called units, not shares. And you own a piece of a partnership. The whole idea is to avoid tax at the partnership level.
Okay, that makes sense. But it immediately begs the question, if it's that simple, just call yourself a partnership, trade publicly, and skip corporate tax. Why isn't everyone doing it? Why aren't all the big companies structured this way? There must be a catch.
Oh, absolutely. A huge one. The gatekeeper is the IRS, specifically the Internal Revenue Code, Section 7704. To get that special partnership tax status, the pass-through treatment, the PTP has to prove year after year that at least 90% of its gross income comes from very specific qualifying sources.
90%. Wow, that's a really high threshold. What was the thinking behind that? Just giving certain industries a leg up?
Pretty much, yeah. The rules were largely set up to encourage private investment in big essential infrastructure projects. Think things that need enormous amounts of capital up front and take a long time to pay off. The government basically created this tax incentive to lure investors into areas like energy infrastructure, things that might otherwise struggle to attract capital. And if they fail that 90% test, the whole structure can collapse and they get taxed like a regular corporation, possibly even retroactively. It's a strict rule.
Okay, so qualifying income is the key. What kind of activities actually count? I'm guessing it's not selling software subscriptions or financial advice?
Definitely not. It's very focused mostly on tangible assets and natural resources. We're talking income from the exploration, development, mining, or processing of minerals or natural resources. That's why you see PTPs so heavily concentrated in the energy sector. Oil and gas pipelines, transportation, storage, also things like timber, some real estate, geothermal.
So if I see a big pipeline company listed on the stock exchange, chances are it's probably set up as a PTP to take advantage of this rule.
Very high chance, yes. And that leads us to the term most people hear, Master Limited Partnership, or MLP. People often use MLP and PTP interchangeably, but it's probably better to think of MLPs as the most common type of PTP, specifically structured around those natural resource rules. It's a public face, really.
Got it. MLP is the common example of a PTP. Okay, that perfectly sets up the tax discussion. Let's revisit that pass-through idea. With a normal stock, the company pays corporate tax, then I pay tax on dividends, the classic double taxation. How does the PTP get around that first layer?
Well, like we said, it's the partnership status. The PTP itself pays no corporate income tax, federal or state, assuming it meets that 90% income test. Instead, all the financial results, the income, deductions, gains, losses, credits, they don't stop at the PTP. They just pass through directly to the unit holders, you.
Okay, avoiding corporate tax is already a big deal, but you mentioned the cash payouts, the distributions. You said they're often higher than dividends and crucially not taxed immediately. How does that work?
Right, this is probably the biggest draw, the real aha moment for many investors looking at PTPs. Unlike a corporate dividend, which is generally taxed the year you receive it, a large chunk, often most, of a PTP's cash distribution is classified by the IRS as a return of capital, or ROC.
Return of capital. Okay, that sounds like they're just giving me my own investment money back, not actual profit.
And that's exactly how the tax code treats it, largely because these businesses are so capital intensive. Think about building a pipeline, massive depreciation deductions. These huge deductions can often shelter the PTP's operating income on paper, even while lots of cash is actually flowing through the business.
Mm.
So, because the income is often offset by these deductions for tax purposes, the cash they send you is legally treated as you getting your initial investment back, bit by bit, and that part isn't taxed immediately.
Can we do a quick example just to make it concrete?
Sure. Let's say you buy one PTP unit for $100. During the year, the PTP does well and sends you a $5 cash distribution. If that were a normal dividend, you'd likely owe tax on that $5 right away. But with the PTP, let's say the whole $5 is classified as ROC, return of capital. You don't pay tax on that $5 now. Instead, you just reduce your cost basis in the unit. So you subtract the $5 from your original $100 cost. Your new adjusted cost basis is $95.
Huh. So the cash goes into my bank account, no immediate tax hit. The only immediate effect is on my paperwork. My cost for that unit is now $95, not the $100 I paid.
That's it, exactly. And you can see how that leads to much higher after-tax cash flow in the near term.
Wow.
That's a huge reason why income-focused investors like these.
Right, but I sense the but coming. The tax doesn't just disappear forever, does it? It's deferred. I pay eventually, presumably when I sell the unit.
Precisely. The taxman always gets his due, eventually. When you finally sell that unit, maybe years down the road, let's say you sell it for $110, you have to calculate your gain based on that adjusted cost basis, which might have been reduced down to, say, $50 after years of receiving those RSC distributions. So your taxable gain isn't $110 sale price minus $100 original cost. It's $60, $110 sale price minus the $50 adjusted basis. That $60 gain is then taxed. Now, the specifics can get complex. Some might be capital gains, some might be taxed at ordinary income rates, especially the part related to those past deductions. But the core idea holds. You push the tax bill way down the road.
Okay, that deferral is clearly powerful, but powerful usually means complicated somewhere else. We need to talk about the flip side, the paperwork and the risks. Let's start with the admin headache.
Yeah, the complexity is a big trade-off. This is where many investors, especially those used to the simplicity of regular stocks, get tripped up. Instead of that nice, simple Form 1099 you get for dividends, PTP investors get the infamous Schedule K-1.
The K-1, I've definitely heard people groan about that one, sometimes called the tax delay form. Why is it such a pain?
Well, because it's not just reporting the cash you got. It details your specific share of everything the partnership did financially, income, deductions, credits, losses, across maybe dozens of lines. Remember, because it's a pass-through, you're technically treated like a partner in the business. The K-1 reflects all that complexity, and maybe even worse. K-1s are notoriously late. Your 1099s might show up in January or early February, K-1s. They often don't arrive until March, sometimes even April, potentially holding up your entire tax filing process.
That's definitely annoying. But the real nightmare scenario I hear about is the state taxes, right? Filing in multiple states.
That is, hands down, the biggest administrative hurdle for many people. Think about it. These PTPs often own assets, like pipelines or storage facilities, that physically exist in many different states. If the partnership operates and earns income in, say, 10 states, then you, as a unit holder, are generally considered to have earned a tiny bit of income in each of those 10 states.
Seriously. So I might have to file 10 different non-resident state tax returns just because I own units in one PTP. That sounds like it could get expensive fast.
It absolutely can. Depending on the states in your situation, filing multiple non-resident returns can easily add hundreds, maybe even thousands, to your tax prep costs, whether you use software or a CPA. So while the PTP structure might save you tax up front via deferral, you have to factor in that ongoing administrative cost and hassle every single year.
It's a very clear trade-off then. Tax efficiency up front versus complexity and cost on the back end. Okay, let's shift to the investment risk itself. You tied it back to that 90% qualifying income rule. It feels like that inherently makes PTPs less diversified.
It does, by design, really, because they must get 90% of their income from those specific natural resource activities. The whole business is incredibly sensitive to volatile commodity markets.
Right. So if oil prices crash or natural gas demand slumps or regulations change for pipelines, the PTP doesn't have like a booming software division or a retail arm to cushion the blow.
That's exactly. Unlike a big diversified company that might have many different business lines, a PTP's profits, and crucially, its ability to pay those cash distributions, are directly tied to the ups and downs of things like crude oil prices, natural gas volumes, or demand for their specific infrastructure. This focused nature means you need a higher tolerance for sector-specific risk. Those attractive cash distributions can, and sometimes do, get cut if the underlying commodity market goes south.
Okay, let's try and pull this together for you, the listener. We wanted to understand PTPs, and I think we've painted a pretty clear picture, albeit a complex one. On the plus side, you get this very tax-efficient setup. No corporate tax hits the entity itself. You get significant tax deferral through that return of capital mechanism. And that often means higher cash flow hitting your account in the short term. For income investors, that's appealing.
But, and it's a big but, you're signing up for significant complexity and specific risks. You have to deal with the K-1 form, which is complicated and often late. You face the very real possibility of needing to file taxes in multiple states. And your investment success is heavily linked to the often wild swings of commodity prices. It's not a set-it-and-forget-it type of investment for most people.
So looking ahead, does this complexity mean PTTs are kind of a niche thing that might fade away, especially as the world talks about energy transition?
Well, here's the fascinating part. Those huge long-term infrastructure projects, whether they're traditional pipelines or maybe new infrastructure for hydrogen or carbon capture or expanded electric grids, they all need massive amounts of capital. And structures like PTPs are actually very efficient ways to attract that private capital for just these kinds of essential long-lived assets. They provide a unique incentive. So paradoxically, even as the energy mix potentially shifts, the need for massive infrastructure investment remains. And as long as that's true, these specialized tax-advantaged vehicles like PTPs, they're likely to stick around as a critical, if complicated, piece of the funding puzzle for the foreseeable future.
Essential, complex, highly specific, definitely a unique corner of the financial world. Thanks for breaking down publicly traded partnerships for us.
My pleasure. Good discussion.
We'll catch you on the next deep dive.